Investing in a growth hedge fund versus an income hedge fund. Buying and selling stocks is a good way to build your wealth, but there's one major risk. If the market drops, your portfolio could decrease significantly. One way to make up for this risk is using a hedge fund, like these growth and income hedge funds listed on Investopedia. What is a hedge fund? A hedge fund is a type of investment fund that pools capital from accredited investors and invests in a variety of assets, often with complex strategies. Hedge funds are generally unregulated and can be highly speculative. There are two main types of hedge funds: growth and income. Growth hedge funds invest in companies that are expected to experience high levels of growth, while income hedge funds invest in companies that pay out high dividends. Which type of hedge fund is right for you depends on your investment goals. If you're looking for rapid growth, a growth hedge fund may be a good choice. If you're more interested in generating income, an income hedge fund may be a better option. The difference between growth and income hedge funds. When it comes to investing in hedge funds, there are two main types: growth and income. Growth hedge funds aim to generate capital gains through investments in assets that are growing in value. Income hedge funds, on the other hand, focus on generating income through investments in assets that pay dividends or interest. So, which type of hedge fund is right for you? It all depends on your investment objectives. If you're looking for long-term growth, a growth hedge fund may be a good option. If you're mainly concerned with generating income in the short term, an income hedge fund may be a better choice. Of course, there is no guarantee that any type of hedge fund will achieve its objective. Hedge funds are complex investment vehicles that carry a high degree of risk. Before investing in a hedge fund, be sure to do your research and understand the risks involved. Pros of investing in a growth hedge fund. If you are looking to invest in a hedge fund, you may be wondering whether a growth hedge fund or an income hedge fund is the better option. While there are pros and cons to both types of funds, here are some of the biggest advantages of investing in a growth hedge fund. 1. The potential for higher returns. Growth hedge funds tend to focus on investments that have the potential for high growth, which means they can offer investors the potential for higher returns. 2. A more diversified portfolio. Growth hedge funds often invest in a wider range of assets than income hedge funds, which can provide greater diversification and reduced risk. 3. More flexible investment strategies. Growth hedge funds usually have more flexible investment strategies than income hedge funds, giving them the ability to take advantage of opportunities as they arise. 4. Greater potential for capital appreciation. Because growth hedge funds focus on investments that have the potential for high growth, they also have the potential to generate significant capital appreciation. 5. Increased access to new and innovative investments. Growth hedge funds often have access to new and innovative investments that income hedge funds may not be able to access. Pros of investing in an income hedge fund. There are several reasons why someone might choose to invest in an income hedge fund over a growth hedge fund. First, income hedge funds tend to be less volatile than growth hedge funds. This means that they are a more stable investment, which can be appealing to risk-averse investors. Second, income hedge funds typically have lower fees than growth hedge funds. This can save investors money in the long run, as fees can eat into returns. Third, income hedge funds often have a longer track record of success than growth hedge funds. This can give investors confidence that the fund will continue to perform well in the future. Why we invest in a hedge fund? We believe that investing in a hedge fund is a smart move for a number of reasons. First, hedge funds have the ability to generate returns in both up and down markets. This is due to their use of hedging techniques, which can help protect against losses when the market declines. Second, hedge funds tend to be more nimble than traditional investments, allowing them to take advantage of opportunities as they arise. This is thanks to their relatively small size and structure, which gives them the flexibility to make quick decisions.